All right. In our last class, we started business valuation, and then we talked about different approaches to actually value a business. And when we started our class, we did mention that business valuation is just like an act of placing a value on the business or, whatever assets that you have, really. And when you talk about business valuation, the essence is really not to get an accurate figure to give you what the value of the business is. Rather, it is just to give you a range of value in which your business value or asset value would actually lie. We talked about different approaches. We started from the asset approach, and the asset-based approach, we are talking about the net asset. And I remember telling us that the word net asset simply means your total asset minus what? Minus your total liability. And under that net asset approach, we talked about different three approaches under that. We talked about the book value approach, right? Or what you call the historical. We talked about replacement. Which other one again? Then realizable value of the asset, right? And then from then again, we went to which other one? Market comparables. And when you talk of the market comparables, all we are just saying is you're looking at an identical asset in the market, trying to use that asset as a basis to place value on your own business, right? And I remember telling us that anytime you're using a market-based approach, it is used by companies that are only listed, because that is where you get indices for this asset or for this company. So for a company that is unlisted, if you're using market comparables and you have a need to use a proxy company to value, you must discount your value by an assumed percentage. And that assumed percentage is to account for what you call illiquidity discount, which I explained to us that in real time, there are models, there are indices they actually use to calculate liquidity discount. But for exam purpose, just do what? Just assume a percentage and just move on. Another, the market-based approach, we talked about the PE ratio, price to earnings ratio. When you talk of price to earnings ratio, all we are saying is the ratio of the market price of your shares or equity to what? To the earnings of your business. So, and I told us that you don't have to cram. What actually gives you a value of a business is the market value of that your asset. So it means if you have a PE ratio that is saying MPS over EPS, it means if I make MPS the subject of formula, it should give me what? It should give me the value of my equity per share or the value of my equity in total when you make that subject of formula. Straight on again, we went to earnings yield, and I told us the word yield is simply just dividing whatever parameter by the market price. By the market price, so that's what gives you a yield. So they're talking about earnings yield. It simply means what? How do you calculate earnings yield again? Anybody? Earnings per share, that's just the inverse of the P ratio. How about dividend yield? Dividend per share divided by what? The market price per share. Fantastic. And then in the two scenarios, all you just need to do is to make the market price per share what? The subject of formula, and then you get the market price per share. Then multiply by number of shares, gives you what? Give you the total value of that equity of the company. And then again, which other method we talked about? We talked about what? The dividend valuation model, right? And the dividend valuation model is not different from what you have done under cost of equity. The only thing we are doing here is just remember your cost of equity. We said KE equals to what? D0 or D divided by what? MPS. So it means if you make that MPS the subject of formula, it can also give you what? The market price of that share, right? So when you have growth, again, you introduce growth into it. So your market value again becomes what? Becomes your D0 into 1 plus G divided by KE minus what? Minus G. All we are just doing is simply still making that MPS the subject of formula. And then again, which other approach did we look at? We looked at the free cash flow approach, which is more like the most common in your exam, right? The free cash flow approach. When you talk of free cash flow, you're saying, remember, we are trying to value a business. I'm saying instead of selling this business outright, I can actually determine the value of this business by simply looking at the cash flows that are going to be generated by this business over a period of time to infinity. And then I'm saying, okay, if I'm renting out this business or this asset, how much am I going to be generating as net cash flow to infinity? And then I can discount that to a present term. And then I'm able to say, okay, the opportunity cost of giving you this asset is actually the cash flow I'm going to be foregoing, discounted to infinity, right? At present time, then I'll be able to place a value on this business. Outside of the free cash flow approach, there are two types. We talked about the free cash flow to equity and free cash flow to what? To firm. Free cash flow to equity, as the name implies, is simply cash flow that is available to who? Only equity holders. Free cash flow to firm belongs to all what? All funds providers. Is the cash flow that is available to all fund providers. That's debt holders and what? And the equity holder. So what then is the difference between them? Free cash flow to equity is discounted using what? The cost of what? Equity. Free cash flow to firm is discounted using what? The weighted average cost of capital. In calculating the operational cash flows, your free cash flow to firm is exactly everything you do in your investment appraisal. Because when you are valuing a business, you're valuing the business, you're trying to appraise a business, rather, you are appraising the business based on the value you can get from the project. The cash flow or the benefit must belong to who? To all providers of funds. What other difference do we have? The other difference is what you call interest. When you are calculating free cash flow to equity, interest is always what? Always deducted from the cash flows, right? When you're calculating for free cash flow to firm, do you deduct interest? No interest. The second thing that's coming from interest part is what you call the financing. Now, when you're doing your cash flow, what's it called? Your cash flow statement. There are three segments, is that not? You have the free cash flow from operations, Abi. Cash flow from where again? From financing, and cash flow from where? Investing. So now, when you're dealing with free cash flow to equity, one thing again that you must remember is that if you have any inflow coming from short-term debt, that adjustment must come into your free cash flow to what? To equity. And I'm going to show us when we start solving, what's it called? When we start doing the illustrations now. And then the last one is what? The last one is the market value what? Market value added. All you just need to do is to calculate your economic value added and then discount that to infinity. And that gives you the market value added. And I explained to us how to actually calculate your EVA. How do you calculate EVA again? No part minus what? Economic capital employed multiplied by what? The weighted average cost of capital. And then I think I remember I gave us a format on how no part is adjusted and how capital employed is also adjusted. And then you use that to calculate your market value added. So this morning we'll be going into illustrations and let's see how fast we can go. Then I told us to go and look at one question. What diet was that I told you to look at? 2024 question 1. How many people looked at? Did you look at it? Fantastic. Who else looked at it? Did you look at it, sir? Fantastic. Online, who looked at it? For a bottle of small Coke? Anybody? No, you solve it now. You looked at it, after looking at it, what happened? You can do it, Abby. If you can confirm to me that you can solve it, I don't have a problem. Provided that if you see that same question, for instance, in the exam, there won't be a problem. All right. So please, I want everyone to look at that question, 2024. It's a very basic question. Very, very basic, you know. All right, please, let's open our corporate valuation question bank. And then let's see how far we can move. Online, are you with me? Online.
We are with you, but you have not started sharing your screen.
My what is not showing? Yes, yes. I'm not on the notes yet. I'm not on the notes yet. Yes. Okay, go to question 29. Question 29 is May 2014, question 1. Wazobia Limited. If you are there, I'm there. Very lengthy question, yet nothing to do. If you are there, I'm there. Question 1, May 2014, question 1. Which pack? Corporate valuation. Do you have the question bank? Question 29. Are we guys? Are we there? Online? Are you there?
Yes, we are there.
All right. The entire share capital of Wazobia Limited, an unlisted company, an unlisted what? Company, is held by 3 directors of the company, Chief Oyomesi, Alhaji Katagun, and I Chief Agbo. They have decided to sell their shares in order to complete a divestment proposal agreed with management, and as such, which to know the likely value of the shares before approaching prospective buyers. Should they fail to get buyers for their shares, the company will go into liquidation. The following information is provided in respect of the company. A. Statement of financial position of Wazobia Limited as at 31st December 2011. Non-current asset, freehold property, equipment that cost less depreciation, current asset, all figures assumed correct. Number B. Extract from the published statement of profit or loss and other comprehensive income for the last 3 years. 2009, 2010, 2011, you have depreciation, director remuneration, profit for the year, dividend, figures assumed correct. It was discovered that inventories were overvalued at the end of 2008 by 600,000 naira. The directors have increased their remuneration in order to reduce company's tax liability. A realistic charge for services rendered would be 1.8750. The equipment is old and it is in need of replacement. The annual depreciation based on current replacement cost is in the region of 3 million. Each of the directors expressed different opinion on the valuation method to be adopted. To Chief Oyomesi, it is most appropriate to value the shares on the basis of price to earnings ratio. For this purpose, he argues that earnings should be defined as the average reported profit for the last 3 years after making proper charges for depreciation and directors' remuneration and correcting the error made on inventories in 2008. In his own opinion, Alhaji Katagun recommends breakup basis using liquidation values as provided by experts. I Chief Agbo, on the other hand, believes that the dividend yield basis be used with available data obtained from 2 similar but listed companies where he is a shareholder. The relevant data of the 2 listed companies engaged in similar line of business as Wazobia Limited as follows. Dividend yield and earnings, price earnings ratio. You have company 1 and company 2, 9%, 11%, 5.4, 6.6. Figures assumed correct. E. Figures obtained from experts for items appearing in the statement of financial position of Wazobia Limited as at 31st December 2011 as stated below. Replacement values and then liquidation values. Free property 15, equipment 865054, and then inventory 4358,000. You are required to compute the value of the entire share capital of Wazobia Limited using A, price earnings basis, with earnings computed on the basis proposed by Chief Oyomesi, and 2, liquidation breakup basis, and then 3, dividend yield basis. Note, assume you are making the valuation as at when? 31st December 2011. Ignore what? Taxation and liquidation costs. Show all workings. 9 marks. Identify any 2 limitations associated with each of the methods above. 15 marks. All right.
Sorry, Mr. Chris, I don't know the question number.
Welcome to class. Can you see the board?
I'm seeing the board.
Okay.
Question.
Do you have this question about corporate valuation?
Yes, I have it.
Fantastic. So, and you can see question 29.
Okay, 29. Okay. Thank you, sir.
All right. So what's the A part asking us to do, guys? Quickly. Valuation of, the name of the question is Wazobia Abi. Wazobia what? Is it limited? Limited. Valuation of equity. The first approach, they say we should use what? Price to earnings, Abi? PE ratio approach. Using average. That's what the question says we should use. Average data. Is that not? And how do I calculate P ratio? P ratio equals to what, guys? Market price per share, Abi, divided by what? EPS, is it not? So that my market price per share becomes PE ratio multiplied by what? EPS, is it not? Now let's get our average P ratio. So our Wazobia is unlisted. Abi, Limited is unlisted. The PE ratio of the proxy companies, Abi, companies, of course, the average, Abi, will be used. That's what the Oyomesi is proposing. And we have 2 companies. Yes, ma.
Mr. Quick, can you hear me? Okay. Sorry. I read the question with you, but I don't know if you can kind of explain the question. Just roughly explain what we are trying to do, because there was a lot of information. I don't really get what exactly they're asking us to do. If you can just give a summary. Sorry.
Okay, so basically Wazobia is an unlisted company, right? And this company, they said they have how many? The owners are 3, I think. One is Oyomesi. Another one is who? Alaji Katagun. And then you have I Chief what? Agbo. They are tired of the business. Long story cut short. They are tired and they want to do what? They want to sell off. They are looking for what? A prospective buyer. But before you get a buyer for your, what's it called? For your assets or your car that you want to sell, what do you do first? We need to value it. And I told us that when you talk of valuation, valuation is not to tell you the exact value of your asset. It is to give you what? An idea or range of value. Because valuation is based on the intention or how do I put it? The assumption of the owner. If I have my 22K car, maybe I bought it for 4 million. I can say I want to sell it for 20 million. What is your own business? It is my car, So the only problem will now be that will you see somebody that will do what? That will buy it at 20 million. So if I want to value, I will say the value of this, my cash will range from 4 million that I bought it up to 20 million naira. So any amount within this range is fine for me. So that means I have a range of value. So now they want to get people that will buy their shares, that will buy their company. But before that, they want to actually do what? Know the value of how much, or to know the value of their business. Now, the three directors are now proposing different approaches. The first one is saying they should use what? What's it called? Earnings, price to earnings ratio, right? The other person is saying they should use what? Break-up basis. Break-up basis is simply saying if you don't eventually get people that will buy it on a going concern, it means you're just going to be selling it off at, I don't know how to put it now, like realizable value, so to speak, what you can get it, you know, when you are not running the business again, who is ready to buy the asset and all of that. And then they gave us those values. And then the last one, the last guy is saying they should use what? The dividend yield approach. And so they said we should use average. So that's what we are trying to calculate. So the first approach is to use what? The P ratio as proposed by Oyomesi. Look at it here. P ratio approach. How do you calculate P ratio? Market price ratio to EPS. Are you good?
Yes,
All right.
sir. Yes, sir.
So quickly go to the question. The P ratio is given to us. If you are there, I'm there. Okay. Company 1, 5.4. Company 2, 6.6, Abi. Total? 12, Abi. 12. And then we'll have average P ratio. Divided by 2, Abi, which is 6. What else do we need to be able to value this? We have gotten the P ratio average. What do we need? EPS. I told us you can decide to do EPS or you can decide to do it in what? In total, by getting what? The total earnings. Is it not? Because this formula is same thing as market value of equity equals to PE ratio multiplied by the total earnings. Is it not? They are the same. I think I mentioned this in last class. The only difference is this one is what? Per share basis. The other one is talking on what? On the total. Now, if you look at the statement given to us, we have statements, their profit is for how many years? 3 years. You have 09, 010, and then 011. And then we need to do what? We need to adjust for what? For those what is it called? The notes that they gave to us. The first note, they said, what did they say? The director, they said the director did something. Overvalue, Abi. So we have overvaluation. What else is there? Overvaluation. Then they said the directors increased their, what is it called? Remuneration, Abi. What else is it? Then depreciation. So we need to adjust these 3 items in this our profits. So let's do that. Computation. Computation of average earnings over the 3 years. So how many years? We have 2009, yes. Okay, 2010 and 2011. So what else? We have their profit for the year. How much is it for 09? That's 3,250, yes. 36, 4,175. 1,000 of you, okay. So we need to adjust. Adjustment for Overvaluation, Abi. Of what? Of inventory. Now let's look at this. When you overvalue your inventory, what's the impact on your profit? Does it understate or overstate your profit? Look at it. Think about it. No cramming. Just look at it. Understate, let me see your hand. When you overvalue inventory.
Overstate your profit.
You
It's
overstate the profit. You overstate your profits.
And that's undervalued. Now that means your profit is understated. Is it not? If you are in doubt, all you do, just go somewhere. You know, I don't like cramming in my life. See, I'll just do revenue. Abi? Let's say revenue is 200 or 2,000, Abi. Next thing is to less cost of sales. Is that not? Less cost of sales. First one is I have opening inventory, right? Let's say that my opening inventory is 150. The actual opening inventory, let's say, is supposed to be 100. Abi? It's supposed to be 100, but I value it to be how much? 150. That means this amount is already overvalued, Abi. Is that not? So I say, let's say my production for this period is 50, and then I have closing to be, let's say, 20. Abi? How much is this? 200 minus this. This is 180. Is it not? If you take this out, this becomes my gross what? Gross profit, Abi. How much is it? 1820. Is it not? But in actual sense, see my profit here is supposed to be revenue, 2,000, Abi. My actual opening stock is 100, Abi. Production, how much? 50. Less closing stock, how much? 20. How much am I having here? 130. Take it out. 1870. See what it's supposed to be. When you overvalue, this is what I'm supposed to have, Abi. But I valued it at how much? 150. What is the impact on this profit? Reduce. So it means to correct this error, what am I supposed to do to it? Am I adding it back or reducing it? Add it back to profit. Simple. Is it not? Because my profit has been understated by the same amount. And so I need to add it back to profit. Is there a problem? Are you sure? Okay. So what do we have here? So we are adding, Abi. Add back. How much is it? They told us how much? 600, Abi. For only this 600. In thousand, Abi. Is this 600,000 or million? 600,000. So we don't have anyone here. What else do we have? Director, Abi. Adjustment for director's remuneration. Remuneration. How much did they charge? No, that's the actual amount now. The actual value is one. Where is that again? They say a realistic charge for the service rendered will be how much? 1875. But how much did they charge in the account? 2250.
Sorry, Mr. Chris.
2,500. Yes, sorry. Yes.
This over inventory that I said is at the end of 2008. Why did we put it in 2009? Sorry, I just want to know.
Opening.
Okay.
Closing for 2008 is opening
Yes,
for 2009.
opening,
So it's
yes.
affecting only 2009.
Okay, thank you.
All right. So what do we have for 2009? Let's adjust. How much did they charge? 25. Minus how much is supposed to be? 1875. How much? 625. For 2010, 29. Let me adjust that. 1025. And then 2011, 1125. So now, are we going to add back or we are deducting? Help me. Tell me why. Fantastic. Class. Yes. That's it. That's it. The next one is what? Depreciation, Abi. I'm asking, should we add back or should we deduct? Eh? Is it network? We're adding back. So tell us why we're adding back online.
Because what is
Hello?
actually meant to be, what is the actual remuneration is 25, but you reduce it to 1875.
Eh?
When it's understated.
Yes.
They charge 2,500 for this 09. They charge 2,500 for instance, but the actual amount is supposed to be 1875. It means they have overstated the profits. So what we are doing is to add it back. Does that make sense? For all of them. So if it was the other way down, you have some that will be jacket, some will be, addition and the rest of them. So basically, but what they charge actually is more than for the 3 years, is more than how much it's supposed to be. So we are adding all of them back to correct that effect. All right, so next is depreciation adjustment. Depreciation. What are we talking about depreciation? Now, let me ask, should we adjust for this depreciation or we should ignore it?
You should adjust.
It depends on what.
We should adjust because it affects the profit.
They've told us the way they are doing it. The depreciation, you are seeing the amount that they charge, and you are seeing the amount that
I can't hear anything. Hello.
Yeah, we are not hearing you, Mr. Chris.
Okay. How much? Is it the same amount they charge all through? Okay. So what is it supposed to be? So that's they charge how much? 2250, and it's supposed to be how much? 3,000 minus 2250. How much is it? 750, 750, 750. Again, should I add back or should I deduct it? Why am I deducting it? Under charge. I'm taking my time to ask this question because I want you to understand the concept, not just solving it. Because I'll undercharge my depreciation, I need to do what? Add back that difference to take it up, right? So I'm doing what? Deduct, Abby? Deduct. And then I'm done with this question, no thinking. And then I have revised earnings. Help me if you have a Casio calculator, figure. Huh? Is iPhone 17 you're using? So our market value based on PERB ratio is what? PE ratio, Abi, multiplied by total earnings. So what's the average P ratio that we can 6, Abi? Multiply by what? 4050. So our market value is around how much? 4, 300.
He's online. Can some is everybody hearing him? Is it my network? It's cracking.
It's the same as me. Yeah.
It's breaking seriously.
His network is not stable.
All right. So what's the next approach, guys? Break up, Abby.
Mr. Chris, we lost you completely from here.
Honestly,
Say
we
again?
lost you. We were even saying, thinking you were on. We are setting the this thing.
Maybe you need
yeah,
to
from
switch
where?
network.
Okay. We just switched network now. So at what point did you miss it?
From this 224, 300.
Fantastic.
When you were calculating,
Look,
okay.
I've not done anything. We've calculated this P ratio. Okay. You have this figure on your notes. First thing that we did. P ratio average.
Yes.
Yes. Do you have this earnings? This one we just calculated at the average earnings.
Yes.
That 455, Abby?
Yes.
Is it not? All these earnings, just add all of them together, divide by 3. That's what we did. And then multiply by the P ratio, this value. And remember, I told us about liquidity discount for companies that are unlisted. This was Obia where value is not listed, Abby. And our assumption is that for companies that are not listed, their share prices cannot be as liquid as those that are listed. And so for that, you have to do what? You need to adjust for what? What I call liquidity discount. And I told you, just assume anything in the exam and move on. For this, we all agreed to use 10%. If you want to use 5%, please go on. Allowed. Anything. It's based on your assumption. If you, so that their value will be 0. I mean what? I don't understand. Basically, it's just your assumption. Like I said, valuation is just about assumption, basically. So, all right. So, the second approach is what? Break up, Abby. Value of what? Wazo using what? Using breakup basis. No thinking. Just go to the question. They will give you the breakup basis for them. Abby, can we see the breakup basis? Look at that note E. You see replacement values. You see what? Liquidation values. Abby? So if you are liquidating, how much are we going to be getting? You see freehold, you see equipment, and then inventory. So we just use this approach to do the two. In some questions, you see historical, you see replacement, you see breakup, right? So you just adjust those figures and then get your value and move on. So we are using the breakup basis. And then go to the question. The first is what? Non-current, Abby. So our non-current asset. So let's do these figures in 1,000. What are the things we have under non-current? Freehold, Abby. Freehold properties. How much is it? Eh? That's the one given to us, Abby. In the question, can we see that? 6.5. But what is
6.5.
their breakup basis value? 15. So that means we are replacing that with 15,000, is it not? If you're doing historical, what you have in that balance sheet is what you are using. Are we good? Do you understand what I'm saying? But this one, they say breakup basis, meaning that the values in the balance sheet are not the items we are using. We are using the items that are given to us based on breakup, right? Next one is what? Equipment. What's the historical value for equipment? I think they gave us that also. But based on breakup is how much? 5 for Abby. What else do we have? We have inventory. So after this, we have a current, that's current asset now, Abby. Current asset. And first we have inventory. How much? Is it breakup? Is it the same thing? Is it the same thing? From the statement is a 6975, Abby. Based on breakup is how much? 8,000. So which one are we using? 8,000.
Yes.
Next, which other thing do we have? Receivables. Are they the same? Or there's no information, Abby? So that means, of course, their breakup basis value will be the same thing as what? As historical. Egone. 4825. Fantastic. 25. What else? Cash and cash. That one, usually you don't have a cash and cash.
650.
How much?
650.
650. Any other thing? Then let's what? Now total. Let's get our total asset. Say again. 33,875,000. Then what else? Less total liability, Abby. Less total liability. The liabilities we have, which one is it? It's only current we have. How much is it?
4150.
4150. Take it out. I think we're done. 29. 29,725, like this. Okay. Total value. Some questions they will tell you, it shock you, Abby. Even myself shock. It's not more than some questions will tell you receivables are expected to be written down by what they will just give you all those. All you just need to do is adjust all those English on the value. Do you get? You know these liquidation values now they gave us directly. Some question will give you that if this is going to be liquidated, receivables is expected to reduce by so amount. Just adjust all those values and then you're good to go. No thinking. It's simple, Abby. For doing nothing. All right, so let's do before that, I need us to do for this other approach. I think we can see replacement. Is it replacement? There's another approach by the side. Yes, they didn't ask us to do, but just for value of Wazobia based on what?
Replacement
value. Please help me with the figures quickly.
Freehold is let's see.
Freehold figure. 15 Abby. What else? Equipment. Now.
8650.
8650. Next.
Inventory.
Inventory. Yes.
4350.
4350.
Yes. Receivables. Is it changing? Figure. 4825.
4825.
Figure.
Cash
Cash
and
and cash.
650.
650. Help me. Total asset 33,475. Less what? Total. Now I'm putting total liability, so you don't think that it's only current liability. It's supposed to be what? Total liability. Remember, we said our asset base is total asset minus what? Total liability.
Total
In case we have
liability.
non-current liability. So our current liability, we're going to help me. 4150. Take it out. 29,325. This is total value of Wazobia. All right. So you can decide to now do historical approach. Historical approach. So that one you go and do it at home. Please complete.
Sorry, Mr. Chris. Please, hello. Sir, can you hear me?
Are they the same? Hold on. Calm down now. What do you mean by historical? Historical is book value now. How much are you carrying this asset? Is it the same thing as what they gave us? Hold on. Hold on. What we did, go to that note E if you have the question. The figures you gave to me, is it from the historical you gave me? This one we just did.
Hello,
Replacement values. 15, 8650, 435. Is it the same thing as what we have? Oh, I get what you mean. Okay. Okay, because already given to, okay, fantastic. I get what you mean. Okay, that's fine. Okay. It's already there, Abi. All right, so the third approach is, I think, what? Dividend yield. What did they say? Dividend yield. Approach 3. Dividend yield. How do you calculate dividend yield again? Help me. Dividend yield equals to DPS over what? MPS. So if I want to get MPS, so remember that DPS equals to dividend yield times MPS, is it not? So that my MPS equals to what? DPS divided by what? Dividend yield. Or I can also say MVE equals to total dividend divided by what? Dividend yield. All right, so let's go back to the question. We are also using average for them. All right, so using average approach. Our average dividend yield, average. Dividend yield. Company 1 is what? 9. Company 2, 11. That's total, Abi, 20. Divided by 2. That's how much? 10, Abi. Is it at 9%, Abi? 10%. So what do we need to get now? Dividend. Is that not? I'll go to the question. What do we have about dividend? Yeah, dividend, is it constant dividend? For the 3 years, constant, Abi. So average dividend. So how much is it? Year 1, 2, 2, 50, plus 2250 plus 2250, all divided by what? 3, Abi, which is 2250. Now, can somebody tell me why we are not going to be adjusting dividend? You know, we are, Remember, we adjusted our earnings, Abi? Okay. Now, let me explain. Dividend relates to how much that the company has decided to do what? Regardless of their earnings. Now, assuming that in this question, they told me that dividend payout is 20%. It simply means that your earnings, when you adjust, you must adjust it. I don't live with that. But if they say the dividend payout is 2250, it means that this amount, of course, is already paid out. They've seen it. All right. So what will be our value? Our market value, Naira 1,000, should be what? We said is what's our formula again? Dividend, Abi, total dividend divided by what? Dividend yield. Total dividend, we're going to 2250 divide. Dividend yield, 10%, giving me what you call 22500. Is that? 22,500. No, Bao. Divide by 0.1 down. So wrong me.
It's 22,500.
Okay. It's a big book. Did you do that question? That 2024. All right. So let's move. I think, are we done? If this one even a question, I don't understand. What's the next one? Are we done? Limitations. You know, I told us that usually when they ask this, they will ask you to explain limitations with the approach that you have used. And I think we've discussed that as it is in your notes. Limitations as it is in your note. I know some people will write it like this. You know, especially those that used to copy after class. When they open the notes and they see, they would write it. When they finish writing it, when they are now reading, you would not be like, as it is. What's the meaning of this one? Oh. All right, so that's that. Basically, so let's look at one more question because of our time. And then there's one other question, 2021 question 1. And like I said, please, I need you to understand valuation very well, because when we get to mergers and acquisition, this is all we are going to be doing. All that we are going to be doing is valuation, right? Value company A, value company B, then you start doing permutation, combine them, synergy, and all of that. So if you understand valuation, it's as good as saying your mergers and acquisition is, you know, almost 80%. You know, so let's look at another question quickly. And that